For a young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Number one goal for monetary policy is to get inflation back to target. In the vast majority of countries, inflation is well above target, and that is the primary concern. Having said that, financial stability is also at risk. So when we are looking at sort of like where we are over time in terms of financial stability, it is very concerning.
Tobias Adrian there of the IMF sitting down with Tom Keene just moments ago. Breaking news here at Bloomberg in the last 10 minutes or so, led by Kitty Donaldson out of London. Here's the lead paragraph for you. According to a person familiar with the conversations, UK officials at number 10 and the Treasury are discussing how they can back down from the Prime Minister's plans for a massive unfunded package of tax cuts. The reaction in the market, pretty simple. Sterling stronger, yields lower. Let's take a snapshot of things for you. Cable off to the races off the back of that headline. The pound a whole lot stronger off the back of this. 110, the low of the session. 112.45 is where we trade right now. Gilt yields lower off the back of this as well, Bramo. Down 34 basis points off the lows of the session, initially off the back of these news, but still lower and lower aggressively so to 4.47, call it 4.48. All going into tomorrow, where the Governor of the Bank of England says it's over. The gilt market operation finishes.
And can we say that the Truss administration blinked? Is this enough? The idea that they're even considering going back on the plans that she said, despite some of the hard language that they've heard. The fact that that triggers this kind of response shows how tenuous people feel right now about the budget of the United Kingdom.
Let's see if the U-turn materializes. One, this is a suggestion they're having conversations about it. And two, if there is some form of U-turn, what do they back down on? And what don't they back down on? And is that enough to satisfy some of the concerns in this market?
Especially because, as you pointed out, a $45 billion tax cut. Is that enough to trigger the turmoil that we have seen? Is that justification for the degree of upset, or is this something else as well?
Well, I've said what's more interesting here, what they announced or how this market responded to it. And I think we can all conclude this is a very fragile market right now. We'll catch up with Guy Johnson in about 10 minutes' time. Guy described this market as febrile. He said this is probably not the best idea when your backdrop is febrile markets, and I'm sure most people would agree. Gilt yields are lower by 34 basis points. TK, big moves in the UK, and a lot to talk about down in DC.
And on to 40 minutes from now, the inflation report in the United States. Everyone here from the IIF, John, the World Bank, and the International Monetary Fund riveted on that 8:30 statistic. Right now, he is the president of the World Bank. Of course, David Malpass joins us. I need to clear something up off of a Politico article, and this is the uproar about senators and your tenure at the World Bank. where something was said, you're not a scientist. I fell off my chair because you are the physics major from Colorado College. Always clarify right now your position with the World Bank, given this turf war, this political war in Washington.
So it's very clear that people cause greenhouse gas emissions, and that affects climate change. And so that should have been clear in the original remarks, and whether you're a scientist or not doesn't matter. And so it got off track. I think we're back on track because what the World Bank is doing is a massive amount with regard to climate change, both in countries that need adaptation, living with the changes going on, and with the mitigation. So there's this intense focus within the World Bank on these efforts.
And what's great about this, folks, and this goes back decades and decades, one of the coolest science majors in America was at Colorado College. The way they taught science at CC was so different back when Malpass was there in physics. Let's go to the equation. S equals VOT plus 1/2 GT squared. There's the gravitational constant in there. Nassim Taleb, the derivative giant, says that G matters right now. What does the new gravity of higher yields and inflation mean for the debt buildup that the World Bank confronts?
Within physics, the gravity is always there. Within economics, there was this temporary period where interest rates could be at zero, and there were various explanations of why that was working. Now it's back to where there is a connection between interest rates and inflation. So the central banks are moving up toward some kind of neutral, where it's non-inflationary. Fiscal policy is also changing massively. One of the themes of this week for the advanced economies is how do you mesh those two policies, the fiscal and monetary policy, so they don't conflict with each other. So if that means you're tightening on one side, do you want to tighten on another side?
But what does it mean for the World Bank and our billions of people in the world adhere to the Bank of England and to the Fed?
This is a really challenging, and I call it a crisis-facing development. People living in developing countries aren't getting capital. In fact, there's a capital outflow. They're seeing their currencies weaken, and a lot of their debt is in dollar terms. So as their currency weakens, the burden of the debt goes up, and interest rates are going up. So that's really a trifecta, a triple burden going on to the countries. And many of them had built up debt under COVID, because that was the cyclical, the counter-cyclical response. So there's been a lot of talk the last couple of days about ways to have a better debt restructuring process for the countries that hit the wall.
Somehow seen through currency, from Mundell to Jacob Frankel and on, we've studied foreign exchange on this, but the modern equivalent is in the derivative space and in the immediacy of overnight swap lines. This goes back to your Bear Stearns tenure. Do you feel we have a stronger structure now with swap agreements with the rich guys, the Fed, to allow the World Bank community to have liquidity in these distorted times?
So developing countries have a challenge in finding swap lines. Some do with the IMF or with the U.S. Fed, but for the poorer countries in general, they don't. They may be able to arrange something, but when that happens, that means you're under the gun. So a better way to do it is to find a way to get to actual debt reduction so that you can have light at the end of the tunnel, get out from under the debt. So that applies to the lower income countries. You know, we're up to where there are dozens and dozens that are where the debt is unsustainable, and that means you need to have some solution to go through it. That's under discussion.
Challenging times, to say the least. David Malpass, thank you so much for joining Bloomberg today. He is, of course, with the World Bank. John Farrow?
Hey, Tom, send our best to President Malpass. Great interview, great conversation as always, and looking forward to your chat with the IMF Managing Director in the next hour or so. Lisa, did you ever think that a UK budget could send equity futures to session highs, up around about 1% on the S&P 500? The prospect of a U-turn, I say the prospect, our latest reporting suggesting the conversation is underway to discuss having that U-turn on certain parts of the budget. Lisa, for all those that have thrown derogatory terms at the UK as being an emerging market, a small country, insignificant, I tell you what, that insignificant small emerging market seems to be shaking markets up a lot.
in a significant way and throughout a number of different asset classes. I pose this to you. What happens then if you get some sort of yield curve control that is abandoned over in Japan? A more significant market, arguably.
You're on to the next crisis already.
100%. Well, I'm looking for the next potential node of contagion.
Can we deal with this one
first?
first?
Fine. Yes, but yes, this one it's amazing, the contagion. It's true.
Well, let's see if they actually back away from big parts of this tax plan first.
Point about the fragility of the market. That was the point that I was making. And this crisis is not over.
We're on the same page. They're repricing the BOE now, aren't they?
Yeah, exactly. Now it's less than 100 basis points of a rate hike in November.
Like that.
Just like that.
Let's see if we actually get any news on this. So far, that's the latest reports. Let's see what they actually do. But the price action speaks for itself. CPI in the next hour.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We keep looking for this Fed pivot. let's fight the inflation first and then worry about that.
I believe that inflation's a little more stickier than what's being forecasted.
We still have policy that is not yet tight.
The Fed, if they acted earlier, they could have stopped earlier, and instead inflation got out of control.
I do think the Fed will start decelerating here. Do think all the inflation lead indicators are falling.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is CPI Thursday, and that number drops in 30 minutes' time. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio right here in New York City with Lisa Abramowitz. I'm Jonathan Farrow. Bramo, futures positive, 1%.
Can we blame or can we attribute the gains right now to the United Kingdom and the possibility of some sort of U-turn by the Truss administration on unfunded tax cuts?
You can blame them or thank them, depending on what side of the market you're on.
I suppose.
But take your pick, sure.
And that really raises some serious issues because if, as you were saying, it is this one market that is dictating the moves, how fragile are markets right now, and how much can that change in a dime? How much do we not necessarily see real volumes with real conviction heading into a CPI print that could dictate the path, at least the near-term path for the Federal Reserve?
A couple of headlines in the last 30 minutes' time. We're reporting here at Bloomberg that the Truss administration, the Truss government, is having a conversation about some form of U-turn, a conversation. It hasn't materialized yet. They're talking about it. What aspects of it will they back away from? The Sun, the newspaper in the United Kingdom this morning, reporting the following, that Liz Truss is considering raising corporation tax next year. So that's one element of the tax cuts they might be backing away from.
Let's talk about what they're funding now. It is a no-cap kind of spending package to try to bring down the costs for individuals who are facing heating bills. Well, this goes back to policy, right? I mean, how do they then crimp demand? How do they then create something that doesn't just become a self-fulfilling prophecy? When people dig into the details, is it still a real sigh of relief? Or what we're seeing in the United Kingdom just highlighting what we're seeing more broadly with costs of financing rising and a lot of nations having a lot harder time dealing with it?
Is Governor Bailey a hero or a villain?
Right now? Well, who is he talking to?
Precisely.
3 days. Get
3
it done.
days. Who is it for?
Who's it for?
Guy Johnson's got thoughts on that. Guy's going to join us in just a moment. I want to run through the market action for you. On the S&P 500, up by around about 1%. The CPI number drops in about 28 minutes' time. The bond market bid yield to lower by 3 basis points on a US 10-year. On a UK 10-year, we are a whole lot lower than that. We'll pick up on that story in a moment. Euro dollar, euro stronger too. 97.41 on euro dollar, stronger by about 0.4%. Out of London, Guy Johnson joins us right now. Guy, your thoughts on what we're hearing in the last 20 minutes?
So we've all been wondering who's going to blink first. I think we now know the answer. I think probably there is an argument to say that Governor Bailey was talking to the government when he said, you've got 3 days to sort this out. He may have been talking to the market as well, but it certainly seems as if that threat has resonated in number 10 and number 11 Downing Street. The market is moving on rumors at the moment. As you say, we still don't know the details of exactly what is going to be reversed, which aspects of the unfunded tax policy that we're going to be seeing changed. I think the Sun report is very, very interesting. John, the market has been all over the place this morning. We initially saw a big move lower in yields. And you do wonder whether or not that is predicated on the idea that we are seeing the Bank of England's policies and the help it's being provided having an effect, or rumours have been swirling about a U-turn. Kitty Donaldson and the team confirming that now, that there is a conversation happening about a U-turn, and you've seen the market response of that. This is what the market was primed for. It was waiting for the government to blink. And it looks like we're getting close to the government blinking.
How much does the government have to blink because of conservative pushback, a pushback from Liz Truss's own administration to say this is infeasible and could potentially undermine any potential growth in the UK for years to come?
I think it's coming from a number of different areas. Clearly within the Conservative Party, there is much annoyance about the way that this has been handled. Her authority has been diminished also almost from the get-go, Lisa, but it's coming from the markets, it's coming from Conservative Party donors, it's coming from a whole host of sources at the moment, and the force of that is now clearly too much for the government to bear. And as a result of which we are going to have yet another U-turn. I'm not even sure which way we're facing at the moment. I think we'll probably maybe find out at the end of the day.
I'm not sure market participants are sure either. Guy, thank you. Guy Johnson out of London. Gilt yields lower on a 30-year by 31 basis points, 4.49 on a UK 30-year. Lucky, happy to say that joining us around the table is David Kelly, the Chief Global Strategist at JP Morgan Asset Management. David, we'll talk about CPI in a moment. Can you tell me what's more surprising to you? What was announced by the UK a couple of weeks ago, or just how the market has responded to it? Just the idea that we've had this much volatility off the announcement of what, 45 billion sterling of tax cuts?
Well, think about it. We have sort of seen a regime change. I mean, for years, we've had a central bank safety blanket, which has really protected markets from anything that might be going on from the political side. And now that has evaporated, and so the bond market vigilantes are back. These happen to be British bond market vigilantes, but it's basically the same situation that we saw back in the 1990s, where central banks weren't necessarily going to help the government out. And I think we're seeing that in the UK. To some extent, I think we're seeing that in the United States also.
Well, maybe, right? And we're getting more calls that quantitative tightening will be phased out basically a minute after it was introduced, because central banks will have to come in and really back up some of these spending plans. From your vantage point, how much can you trust that versus bet on yields going even higher from here, whether it's the US or the UK?
I don't expect yields to go much higher from here, because I really think we have turned the corner on inflation. I think there's, we're not talking, nobody is saying that really inflation's going higher. We're simply talking about the slope of the slide in inflation. And I think, whatever number we get today, I believe that CPI inflation might be 8% year over year. Today, 8.1. By December, it's going to be 7%. It is coming down. And because inflation is going to come down, I believe that means we should be close to a top on yields.
Although, even if it's coming down, 7% is not going to be very comforting. Neither will 6%. And possibly not even 5%, even if it comes down pretty quickly, if it starts to decelerate in terms of how quickly it comes down. And if core inflation continues to accelerate even in the month of September.
Well, first of all, the historical record is that if you look at inflation, inflation goes up and comes down. It looks like the Eiffel Tower. And whenever we've seen this in the past, unlike unemployment, which looks like a playground site, it sort of goes up and then comes down slowly. But inflation tends to come down quickly. And the only part that's really sticky here is shelter. And that's owner's equivalent rent, which nobody pays. So the part that's sticky doesn't matter. And so I really don't think that I think we're just too obsessed with inflation because we haven't seen this beast in 40 years and we're just all a little too excited about it. And it's just not that threatening and not worth putting the US economy into recession over.
Well, that's what the Fed is doing, isn't it? 300 basis points worth of tightening in 6 months. Isn't that the risk it's taking?
I think they're overreacting to it. I mean, I don't mind the Fed getting back to normal. I think they ought to, but they said they wanted to not add to uncertainty. They're adding to uncertainty. So what they should do is say, look, this is what we're doing, and we're trying to get back to normal, but then we're going to stop because we don't want to kill the economy for an inflation battle that we're going to win anyway.
You know better than most that getting into the debate about what they should and shouldn't do, ultimately we can do this for hours. Lisa loves it. It's a sport. I love it too.
Play it all the time.
What they will and won't do is what matters ultimately to this market. Can you tell me what you think is going to happen here, given what they're set to do
I think
through the next 6 months?
I think they're still very sort of self-conscious about this. So I think they will go 75 in November. They will go 50 in December, probably go 25 at the start of February. But then I think they'll stop. And I do think that within the next year, we will see a Fed pivot of sorts, because at some stage they've got to find themselves an off-ramp from this. They want to sound hawkish, but they know. I mean, a lot of economists are saying what I'm saying. I'm startled by how many economists are seeing this, exactly the same thing. With inflation is coming down, they don't need to put the economy in recession to kill it.
So this sounds like you are getting long, or you already are long, some of the longer-dated bonds, particularly in the U.S. Is it positive for risk assets if they start to decelerate the pace of rate hikes into year-end and into the early 2023?
Yeah, I think so, but I think the setup is positive for risk assets because, frankly, everything's on sale. I mean, we're down 25% on equities from a year ago, and so things are on sale. And I think what's going to happen here, we've got a lot of uncertainty right now, but at the end of this, we're going to emerge with a very slow-growing economy with low inflation. The Fed's going to have to put in low interest rates because fiscal policies are going to be stimulative. And so you're going to have low growth, low inflation, low interest rates, probably decent profit margins. And that's actually a pretty good environment for financial assets, both stocks and bonds.
Are you saying pull out the pre-pandemic playbook and...
Yes, I think it's back to the future. We're going to end up, because of the Fed overdoing this, we're going to end up back where we were 10 years ago.
So this is not some big structural shift. This is just an aberration the last 2 years or so.
Correct. If it was a structural shift, you'd see the unions back. The unions aren't back. 10% of America is unionized. It was over 25% in the 1970s. You'd have different markets which weren't sort of instantaneous. Would have a lot of wouldn't have internet technology allowing you buying anything you wanted at any price immediately.
So is this going to be another bond bull market?
Well, it's not that, a bit of a bond bull market, but we're only going down from, if we go from 4 to 2, that's, you can make some money there, but it's not like the great bond market, bull market from the 1980s.
This is the constructive view on things.
Yeah, well,
the old playbook, the old regime.
And he's not alone, right?
no.
I mean, there are a lot of people who think that we're going to go to an even lower terminal rate post-pandemic after this blip, simply because of the amount of hangover and the slower growth that you're going to end up getting because of some of what we're hearing from the Fed right now.
Given how wrong we've been about 20 different things over the last couple of years, I'm doing my best to stay open-minded about the whole thing. I've got no idea.
Open. Yeah, I have no idea.
No idea. David Kelly, thank you, sir.
Anytime.
I'm not saying you should be open-minded, just saying,
well,
it wasn't personal, David.
Well, no, I mean, but I think that you have to be open-minded because
This
we
cycles
don't.
move so quickly.
So my father is a mathematician, and he used to say to me, you look at all these equations, but you never know the parameters, and you always get the parameters wrong.
Yeah.
And right now, no one knows what the parameters are, and so you're making assumptions based on whether we're going back to the normal of 10 years ago or 5 years ago, or we're going back to the normal of 20 or 30 years ago.
Will he do a phone interview in 20 minutes' time?
Oh, please. He's in
On
Italy right
CPR.
now. He's doing great.
He has no interest breaking down inflation in
He
America.
can talk about the euro and
Okay.
how happy he is about it right now. It's
Coming up,
expressive
Jeremy
purchases.
Stretch. Does he need a research assistant? I'd love to
the
join.
El Duomo.
Jeremy Stretch is going to join us from CIBC in just a moment. Inflation 19 minutes away, live from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Pfizer and its German COVID vaccine partners say their booster shot, tailored to the latest Omicron variants, appears to offer better protection than the original against currently dominant versions of the virus. The latest data is the first evidence that the vaccine does provide better protection compared with earlier shots that were based on the original strain of the virus. China is defending its controversial and costly COVID-0 policy for the 4th day in a row, this time through one of the country's top virus officials. A National Health Commission expert saying at a briefing today that it's inevitable the curbs the country uses to control transmission have impacted the economy. The comments come just days before President Xi Jinping is expected to secure a precedent-breaking third term in power. Meanwhile, in Beijing, about 24 police patrolled a busy intersection after photos and videos circulated of a rare protest attacking President Xi Jinping just days before that crucial Communist Party meeting. At least a half-dozen photos and videos on social media showed 2 unfurled banners across the bridge in northwestern Beijing. They took aim directly at Xi, criticizing his restrictive COVID-19 policies of lockdowns and mass testing. Heavy rain in southeast Australia is forcing hundreds to evacuate their homes. Thousands more are without power. Rivers across Australia's most populous states have reached dangerous levels after months of above-average rainfall. Around 250 homes west of Sydney were ordered to evacuate ahead of major flooding. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface, and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pushing inflation down below a certain level by lowering wage inflation, pushing unemployment up, is going to become increasingly difficult for the Fed to stick to that policies, especially when you're having all these problems in other parts of the world. So the pressure is going to mount on the Fed.
Andrew Sleman of Morgan Stanley Investment Management. We are 12 minutes away from CPI in America. Going into that number, your market shaping up as follows on the S&P 500 into Thursday. 6-day losing streak right now. Futures positive, 39 points, up by 1.1%. Yields are lower by 3 or 4 basis points to 385.98. This headline just out of Germany, the Bundesbank, for those of you that missed this. German 23 inflation, so inflation next year, likely to be between 7% and 8%. Lisa, that is next year. Not the end of the month, not the end of this year. They're still looking at a 7 handle and 8 handle in Germany next year.
And where was it 6 months ago? I mean, this is the other aspect of this.
Sure.
It was way, way, way down from that. And so how much and how quickly are things developing? They're also downgrading their growth forecasts pretty dramatically because this is the stagflationary fear that so many people had, and Germany is in the crosshairs.
It's materializing. Let's get the view from Jeremy Stretch, the head of G10 FX strategy at CIBC. Jeremy, in about 11 minutes now, I'll keep counting us down. CPI just around the corner. What are you and the team looking for?
Well, I think after the PPI release yesterday, I think there is definitely a definitive fear that we could see a slight nudge to the top side, particularly in terms of core prices. So I think that could be a function which will provide a little bit of residual support for the dollar and really maintain that narrative of another 75 beep of policy tightening coming in the next FOMC.
Jeremy, you noted that this is a big short squeeze on the pound and that you're seeing these whipsaw movements because people are leveraged and getting in and positioned very much in a loosely traded market right now. There isn't conviction in terms of where people are going. How much is that becoming a theme? Is going to create that much more volatility going forward, even if these reports are confirmed with details?
Yes, that's right. We are seeing a definitive short squeeze over the course of the last couple of hours or so, and that's really a function of incredible degrees of speculation here in the UK that could either be a fiscal U-turn of some form being discussed by the Prime Minister, Liz Truss, whilst, of course, notably the Chancellor and the Finance Minister is in Washington, meeting with the IMF today. And also at the same time, there's increasing speculation that the Prime Minister's own tenure, which is only 37 days old, could also be under extreme threat. So that is creating this short squeeze. It's creating a significant degree of rebound or rally in the gilts market. But there is a lack of conviction because, of course, all of these reports are consistently either denied or often rubbish. So there is a great deal of volatility. And that really makes it very difficult to hold any position with any conviction for any length of time.
Looking at these moves in stocks on the FTSE 100 as well. Barclays this morning rallying. Lloyds Banking is up by 6.3%. Barclays up by 4.8%. Can you tell me, Jeremy, if they are discussing this, and we're reporting that they are discussing a U-turn, what we don't know is whether they deliver on that U-turn. What are the elements of the tax package that would need to be backed away from that would convince you enough to come into this market again and say, let's buy sterling? The policy setting on either side, monetary, fiscal, is a little bit more durable now. I think we can buy the pound here.
Well, the first problem is, of course, that fiscal and monetary policy appeared to be moving in completely opposite directions in the context of that fiscal event. So I think we need to see some degree of reduction in terms of the fiscal expansion, which was implied by those tax cuts. So it may well be the case that that reduction in the basic rate of tax could be pushed forward by a year. Now, that's not a big revenue raiser, but I think that will reduce some of the fiscal impulse from next year, and that will ease some of the burden on the Bank of England. Also, interestingly, there's some debate about some degree of corporation tax hike coming back into the agenda. And of course, that's very difficult when you're trying to drive for growth. So I think the government are in a really difficult spot here. But I think if there were to be any reductions in terms of that fiscal expansion, which was really driving inflation dynamics through the course of next year and making the job of the Bank of England all the more difficult, then that could create conditions which would be constructive. And of course, if Prime Minister Truss were potentially going to be removed or at least taken out of the equation, then I think you could easily see sterling getting back to maybe a 117.5 handle. So there is plenty of scope for a degree of rebound in sterling, but it is very much a function of these rumours, or at least some of this speculation, proving to have some degree of durability.
Again, let's see if there's any follow-through whatsoever, though. Jeremy, I think the question I'm trying to ask is that even if they walked it all back, went back to the very beginning where they started, didn't do any of this stuff, would you see any scarring on sterling assets? Would we have to have an additional risk premium baked in?
Yes, I think that's undoubtedly true. As we all know, that once you lose credibility in any way, shape or form, whether it be markets, whether it be relationships, it takes a long, long time to rebuild credibility and rebuild confidence. So I think the confidence in UK PLC as a major G7 trading nation has been materially undermined by the events of the course of the last 2 to 3 weeks. Official institutions have obviously been compromised, whether it be the UK Civil Service, whether it be the Office for Budget Responsibility. So I think it would take some considerable time for UK assets to move back to absolute valuation levels. And I think there will still be a degree of credibility discount being put in place in terms of UK assets over the course of the next few weeks and months, even if all of these fiscal events and the political risks are compromised from what we've seen over the course of the last 2 to 3 weeks.
Jeremy, it seems like the crisis is now over in the United Kingdom. That's tongue-in-cheek if anyone pushes back and says that's absolutely not the case. We can move on to the next crisis.
Right.
All right, so I'm looking right now at the yen, and we've been looking at it approach the weakest levels going back to 1998. It hit that yesterday. What vulnerability is there that was really exposed, thrown into relief from what happened in the United Kingdom, if there is some sort of policy shift over in Japan?
Well, clearly, we've seen the MOF intervening for the first time in obviously 25 or almost 25 years. But the underlying metric and message is that if Japanese monetary policy is still going to be very divergent from the rest of the world, then the path of least resistance is probably still dollar yen moving higher. And I think that's going to be very much the sort of the ethos that's going to remain in play during the final stages of Kuroda's tenure, because his position will come to a conclusion. His 10-year term will end at the end of Q1, and he still feels confident that, or necessary, for monetary policy stimulus to remain in play, because there is a lack of wage growth, and that's the real crux of the issue for Japan. But I think we're starting to see some of those inflationary pressures moving down the pipeline, and that's going to squeeze corporate margins, and that's going to make it even more difficult to see any sustainable wage growth in Japan. So I think it may well be the case that it's going to be the job for the next governor of the Bank of Japan to try and pick up the pieces or the deal the ramifications of this protracted and prolonged period of easy monetary policy, which inevitably is probably going to see dollar yen squeezing higher until markets are confident that probably US nominal yields have reached a peak.
What a tough task for whoever takes over. Jeremy, thank you. Jeremy Stretch there of CIBC. Looking at it from Kuroda's perspective, and I don't think we do that enough, I believe the BOJ sees this as a once-in-a-lifetime opportunity to reset inflation expectations higher. This was the ultimate goal for the last 20, 30 years of policy. Here it is, the opening for them to do it. I've sat here and said it looks like they've got their head in the sand whilst the rest of the world is hiking interest rates. I agree with you, to back away from yield curve control will be tremendously difficult. But from their perspective, they don't see these inflation numbers in Japan as a problem. They see it as an opportunity.
What happened to you? You're all open-minded, thinking of all the other sides today.
I did some yoga last night.
I mean, what is
And
this?
this morning, very zen.
I mean, what's mindful meditation that you're doing?
A lot of mindfulness.
Open-minded. We don't know
Or
anything.
maybe it's Tom's not here and I'm just a little bit more relaxed.
Think about it from his perspective.
CPI in America, up next. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight
We think that's the next secular shift.
from business's most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. 10 seconds away from inflation data in America. Going into this, equity futures just off session highs on the S&P 500, up a little more than 1%. With the data in Washington, D.C., we can cross over to Mike McKee.
Well, John, it looks like the score is inflation 1, Fed nothing today, as the CPI comes in up 0.4% on a month-over-month basis, which is higher than it was last month and higher than expected. And the core, which the Fed is following much more closely, comes in up 0.6, same as last month, and more than anticipated by the markets. This is exactly the same thing that happened last month, and we saw a big reaction in the markets. On a year-over-year basis, the headline CPI drops from 8.3 to 8.2% as base effects come into that. But for the core, it rises to 6.6% from 6.3%. So it is not a good picture here. Those who were thinking that inflation might drop off fairly quickly are going to be disappointed by the numbers here. Why don't you let us know what's happening in the markets, and I'll look at where the big movers are.
Yeah, let's do that, Mike. As you say, it's off to the races. Down and down hard on the S&P 500. We're negative by 1.5% on the S&P. When you push this through the bond market, look at the front end of the yield curve. Through 440 on a US 2-year. So that is a new high for the year and a high we have not seen since 2007, up 10 basis points on a session now at the front end of the curve. On 10s up 7 to about 397, breaching through 4% a couple of times over the last couple of weeks, but yields up and away again at the front end seems to be the theme of things right here. At least the wrong kind of upside surprise, and pretty much across the board here on core month on month, which is what Wall Street was looking at. The front page of the newspaper will go with the headline year over year, and let's be honest about it, that is not pretty either.
Especially at a time when people are talking about how you are seeing lower energy prices, you are seeing certain retailers start to discount items. It is not feeding through. How much the fact that we're not getting a flatter yield curve materially, so the fact that you are getting higher yields at the long end as well, indicates that perhaps people are rethinking some of these inflationary inputs and how quickly they can roll over, John.
Inflation coming in hot, Mike McKee. Have you got the compositional breakdown yet, Mike? Just the detail of things. What got us here?
Yeah, it is disappointing, John, when you look at it. Of course, gasoline comes in down for the month, down 4.9%, but that wasn't enough to offset some of the big rises. Shelter, which, of course, everybody is pointing to as the big culprit for inflation these days, is up by 0.8, which is a tenth more than it has been over the past 3 months. There was hope that it might start to moderate. Owner's equivalent rent up 1%. And that's the calculation that people do, the government does for shelter. There was one decline in apparel, down 0.3. That's the inventory stuff that Lisa is talking about. Used cars were down by 1.1%. We've been waiting for a big drop there, but new cars come in up 0.7. And then the big thing that probably people were not expecting is gasoline goes down, but other energy goes up. Electricity up 0.4, and natural gas up 2.9%. So a lot of inflation contributors from areas that we weren't expecting. Some had thought that airline fares would go down. They're up 0.8, and motor vehicle insurance, which has been a problem for the Fed all along, is up 1.6%. So a lot of underlying inflation that shows no signs of backing off.
A couple of months ago, Mike, we were talking peak inflation, and perhaps people were talking about the headline number. Are we getting closer to peak inflation when it comes to the core?
Well, you have to think that it's going to happen in one of these months because the Fed has been tightening, and it should start to have an impact. But as the Fed said, with the labor market as tight as it is, companies are still probably adding employees to the extent they are at higher wages, and that means they're passing it along to consumers. Jim Bullard of the St. Louis Fed has said basically it's up to the companies. They feel they have pricing power now, so they're using it. They need to realize that they need to back off, or it's going to hurt everybody.
Mike, this was never about the November meeting. The November meeting was 75 almost nailed on. It was about whether in the news conference this Fed, this chairman, could lay the groundwork for a downshift from 75 to 50 to 25. Given the data calendar from now to there, do you think it's going to be very difficult for this chairman to lay the groundwork to do just that?
It's going to be very difficult. They want to get to 4.5%, 4.5 to 4.75 by March of next year. They may be forced into doing it earlier. The sequencing was supposed to be something along the lines of 75 in November and 50 in December, but now 75 for December has to be on the table. We will get the PCE inflation numbers just ahead of the next Fed meeting on November 2nd, but barring a big drop in that, and it does count housing a little differently, I think you're going to see a hawkish Jay Powell in the news conference after their 75 basis point move.
Hey, Mike, great work. You're going to stick around and stay close, I know. A shocking number for a lot of you, I guess, Lisa. Those of you that were looking for some kind of downshift in the inflation story that would lead to some kind of downshift from the Federal Reserve, I'll price up the markets for you, and it looks a little something like this. Pretty intuitive, self-explanatory off the back of this one. Inflation comes in hot, and equities roll over. We're down by 1.8% on the S&P off the back of a big move at the front end of the yield curve. Two's up 15 basis points to 444. We have taken out the highs of the year on a 2-year, and we're set to take out the lows of the year on the S&P 500 at the opening bell. In the FX market, session highs, guess what, dollar yen? 147.40. Bramo approaching 150 on that currency pair.
It pretty much sums it up. Andrew Brenner over at Net Alliance Securities sends out a note saying, will they go 100 basis points? Is that really where we're back to, John, as people talk about upside surprise after upside surprise, 2 consecutive ones, PPI not as important as CPI, but not indicating that you're seeing that sharp V-shaped decline that we were hearing about from David Kelly?
Can we touch on the politics briefly? In the next hour, I'll catch up with Brian Deese, Director of the National Economic Council. I think this was the last inflation report before the midterms. The next one comes a few days after. This is a tough spot for them.
It is, especially because you're not necessarily seeing wages keep up. This isn't leaving anyone in a good position. And what you're seeing is that the lowest income individuals tend to be hurt the most, especially with things like airplane tickets, like rents, like food, like shelter. Everything is going up, and it's making it very difficult for people to feel in a good spot.
So headline inflation comes in at 8.2%, down from the previous month of 8.3%. We were looking for 8.1. That will be your headline in tomorrow's newspaper, no doubt. On Wall Street, the focus is month-over-month core, 0.6%, in line with the previous month of 0.6%. That is month-over-month. We were looking for something like 0.4. This is hot. It's an upside surprise, and it's sending this market, this equity market, a whole lot lower. Seth Carpenter, Global Chief Economist at Morgan Stanley, joins us right now. Seth, you've had about 7 minutes to pour over the details. Your take on this one, please.
Yeah, absolutely. So I have to say, I'll crow a little bit and congratulate my team. So our U.S. economics team, Ellen Zentner, the chief, Julian Richards, who works for her, we were above consensus on our call for this print. I think the stickiness that you saw in the shelter inflation was one of the key things. And so clearly a shock for the markets. The markets are off because of it. But for us, this actually didn't come in very different from where our forecast was. There is persistence, especially in the services side of inflation. The apparel number I thought was particularly useful, though. For a long time, we and others have been talking about inventories, the pullback of the consumer from consumer goods. We're starting to see it. The challenge, obviously, in this context is it's when other bits of inflation, as Lisa pointed out, are just going up more strongly.
Right now, we're seeing the swaps market price in a peak policy rate for the Federal Reserve of 4.85% in March of next year. Seth, is that what's required for the Fed to move fast, to continue moving into next year, despite some of the concerns about financial stability?
Yeah, I'm not sure that is what's required. That's a little bit above where our call is for the peak rate, but only by a hike or so. I think there's two-way risk with that outlook. We have seen the last jobs report was good, but still softer than the one before. And so if we get that downward trend continuing in non-farm payrolls, if we get down into the 100-something range, I don't know that it's going to be obvious to the Fed that they need to keep going all the way up, closer to 5%.
Seth, I'm struck by what you said. There's certain other areas outside of shelter that were stickier. And I'm thinking about airplane tickets, people saying that after a while, people wouldn't be willing to pay for something that often is a discretionary expenditure. You could see this with IKEA and Pepsi all raising prices and still having pretty good sales. Are you concerned that your team and that you have been a bit too sanguine about how quickly inflation could come down on the other side, about how pervasive even the wage stickiness is right now?
Absolutely. If ever there is a time for people who do economic forecasting to be humble, this is it. It's very, very difficult. The sort of falling off of inflation for core goods has taken so much longer than we expected. I think there's a lot of uncertainty here. The fact that the labor market is in fact cooling. We obviously got the JOLTS data a couple weeks ago that the market reacted to. We got non-farm payrolls that was solid but still coming down. I really think that part of the economy is going to be key. Can the Fed continue the tightness, get the overall economy to slow down, get job creation to slow down? That, I think, will be the key to where inflation goes over the medium term.
If you're just tuning in live on TV and radio, you missed the fireworks. Core CPI in America coming in at a 40-year high. Inflation coming in hot. Equities heading south. We're down 1.8% on the S&P. Yields up at the front end of the yield curve, up 14 basis points to 4.43, and expectations high going into the Fed's next meeting. Last time they met, Seth, in the minutes yesterday, they said the cost of taking too little action to bring down inflation likely outweighs the cost of taking too much action. Seth, do you anticipate when they meet again in November, they'll be thinking the same thing?
I think they will be wringing their hands quite a lot. This was obviously an important data point, but it was one data point. The minutes also pointed out that at some point they're going to have a discussion about calibrating the size of the rate hikes because they don't want to go too far and do too much. So I think they're getting to the point now, once we get close to 4% or over 4%, I think they really will be weighing both sides of that coin. The strength of the underlying economy is important, but inflation here is clearly strong. There was the point about used car prices having come down, but new car prices staying strong. I think it's exactly those sorts of frictions that are going on in the goods and services market that is presenting such the conundrum.
Well, there's a lot of friction right now in this bond market, let me tell you. How far can we push this up? 16 basis points, Lisa, on a 2-year, 445.
I'm watching this, and now we're at 445.3. I mean, it just keeps going up higher as the terminal rate now is looking at 4.85%. It is moving closer to that 5% handle that we heard about from Larry Summers, that we heard about from Bill Dudley, and people laughed.
Can I just say Bill Dudley said that in the summer of 2020.
He nailed it.
He was talking about maybe, summer of 21 rather, he was talking about maybe they'd have to go a whole lot further than people thought they would. Stacked lineup in the next hour for you. Mona Mahajan of Edward Jones, Jim Karen of Morgan Stanley Investment Management, Tom Kennedy of JP Morgan, and Brian Deese of the National Economic Council, the director, The View from the White House, on a tough day for policymakers, Lisa.
I'll let you run off and get to it, and I cannot wait to hear those interviews, in particular with Brian Deese, and we're still with Seth Carpenter of Morgan Stanley. I would love to get your take, Seth, on the political element of this, particularly as we heard from our own Michael McKee, that energy prices outside of gasoline were rising. We've seen this with diesel. We've seen this with heating gas, with natural gas, heading into a winter where inventories are at historic lows. How much are you concerned about this triggering a new bout of inflation, even at the headline level, that could pose a real problem?
I think it really could, and at the headline level, I think there are no two ways about it. There's the winter weather is going to matter a lot. I think this is an issue that our friends across the Atlantic and Europe know even more. If they have a very warm, very cold winter, it's going to be disastrous for them in terms of their supplies of natural gas. But no question, energy prices are susceptible here, and the average consumer doesn't look at core the way the market does. The average consumer looks at the things that they're just spending money on and that they see on a day in and day out basis. And food and energy are very high on the list for the average household.
And Seth, you were talking about the bifurcated nature of where people are spending money. And I wonder how much this speaks to the uneven fortunes of people with money and people who don't have as much, about how people at the higher ends are able to buy new cars, and big ones at that. What I hear from a lot of executives is correct in the auto industry, while other people can't afford the same kind of groceries that they had in the past. How does this end, Seth? I mean, what is the sort of trajectory for the overall economy versus the pockets of potential pain?
It unfortunately tends to be the case with every downturn in a business cycle that the people at the lower end of the income distribution tend to fare worse, and so it ends up exacerbating a bunch of the inequality. If we think about the story that was so popular 6 months ago, 9 months ago, about the amount of excess savings in the economy because people weren't spending as much during the worst part of the pandemic and the government transfers were strong, it does look like, from the estimates that we've done, most of that excess savings has been spent down for people in the lower quintile, maybe the lower 40 percentile of the income distribution. Not so for the top of the income distribution. So again, that's another place where we are seeing this disparity really showing itself.
And helping to perpetuate some of the inflation. Seth, stick with us for just a moment. I want to go back to Michael McKee in Washington, D.C., just to bring you the latest if you are just tuning in. CPI, the core level, reaching the highest levels in 40 years, since 1982 at 6.6% year over year, higher than expected. Even headline came in higher than expected, albeit lower than its recent highs. Over the past few decades, Michael McKee down in Washington has been parsing through all of the details. We talked about how used cars have actually declined, but new ones have continued to rise in terms of their pricing. What are some of the details as you continue to parse through this, Mike, that you think will shape the conversation?
Well, I think it's, in general, the overall number of things that went up. When you look at the list of the breakdown of everything in the CPI, most everything under the apparel category fell, but that's the only one that shows anything like that. Services outside of energy up 0.6. They're up 6.7% for the year. That is not what the Fed wants to see. That's driving the core higher. And the part of the problem is they haven't yet been able to get a cap on expectations by businesses that are raising those prices. We'll see if that starts to come through. And then, as you were talking about with Seth, I think the natural gas issue is one that's probably going to come back and bite people as it gets colder, as gas use gets more significant, as we sell more gas overseas. There are already some people on Capitol Hill saying maybe we should cut off gas sales to Europe, and so especially because of Ukraine. And so there's a lot of political stuff that's going to go into this as all the world's central bankers and finance ministers gather here at the IMF for their meetings. They'll be talking about the U.S. because the U.S. inflation is so high, the Fed has to keep going, driving the dollar higher and affecting everybody around the world.
Mike, thank you so much. Great work as always. Stick with us. We will be heading back to you shortly. Seth, from your perspective, right now the market's response is pretty fierce. You're seeing a sell-off accelerate in stocks, in bonds. In stocks, you're seeing the S&P down now 2.2% ahead of the open. NASDAQ down almost 3% after already a very difficult year. At what point do financial stability concerns start to play into this at a time where inflation is still so obviously a major concern?
So I think the sell-off in equities as one example is something that my colleague Mike Wilson has been calling for. The key for the Fed is slowing the economy enough to get rid of these inflation pressures, and so marking down those earnings expectations is going to be key there. And so that goes into the level of prices. But it's not the level of these asset prices that I think are the financial stability concerns that the Fed will raise. It's how volatile things are. Is there some part of a market where things are starting to break? Is there, if we see credit spreads widening, well, with a slowing economy, maybe that's what should happen. What they're going to be more concerned about is, do they move wider in very, very short order? So something along the lines of what we saw in the UK a week and a half ago, where you saw a huge move inside of a single day. So far, we've just seen what seemed like the normal reactions, the repricing as the data come in. I think the Fed's really more worried about volatility or a lack of liquidity.
Although we're seeing in the auctions, the Treasury auctions over the past few sessions, we've seen in certain sessions of trading, there has been incredible volatility, particularly the early hours over in Asia, over in Europe. How much are you getting some sort of pats on the back from some of your colleagues over on the trading desk at Morgan Stanley, your colleagues at the Fed where you formerly worked, saying, it's starting to get a little bit more dicey?
Yeah, no question. I think everyone in markets is talking about exactly that phenomenon. But I think for the Fed, they're strapping themselves in for this. They're sort of expecting some increase in volatility because the world is uncertain. I don't suspect the folks at the Fed yet see evidence that there's something that's not working in markets to the point where they're worried about it.
So given that, Seth, how much are you ratcheting down your expectations for growth, given that you are seeing the markets sell off, but not necessarily dysfunction, that you're seeing certain types of inflation come down, but not nearly enough to give anyone comfort?
Absolutely. So our baseline view for the U.S. Next year is very, very weak. Only roughly in the 0.5% range. So that's a pretty pitiful amount of growth. I think another metric to think about that is we're looking at job growth to slow down to the 50,000 or so per month range, which is a far cry from where we are now, and particularly far cry from where we were 6 months ago and a year ago. So growth has to come down a lot if the Fed is going to contain these inflationary pressures, and that's going to be, in the words of Chair Powell, economic pain.
Seth Carpenter, thank you so much for all the time that you've spent with us this morning. Seth Carpenter of Morgan Stanley down in Washington, D.C. with the rest of all the policymakers and many of the people here at Bloomberg. Just to really reiterate what we're looking at right now, the sell-off that is deepening in U.S. markets in the heels of a worse than expected, a hotter than expected inflationary read. Mike has been pouring through it. There is some talk about, with the financial stability issues, Mike, that there will be discussions of perhaps stopping some of the quantitative tightening early. From the policymakers that you speak with, how much is that on the table?
It doesn't seem to be on the table. At this point, they're not seeing, they say, any signs of real stress in the U.S. economy, nothing like what's been going on in the U.K., and they want to give it a few more months and see what the bump up to $95 billion a month in roll-off is going to do. There are people who suggest that the Fed needs to start looking at this because not just the Fed, but the government's involved. As the Fed backs off, the Treasury is selling even more debt to pay for everything that we owe, and the markets may not be able to absorb all this. So that's going to be something that will be discussed here at the IMF and World Bank meetings, whether or not the Fed wants to change its views and maybe move up time to slow or taper their QT is still an open question, but right now the Fed is saying they don't want to do that.
Michael McKay down in Washington, D.C. Thank you. Right now, let's get Ira Jersey on the line. He is, of course, our chief U.S. interest rate strategist at Bloomberg Intelligence. And right now, I'm looking at a peak Fed funds rate in March, at least as priced into futures markets on the terminal, 4.85% by March of 2023, getting closer to the Bloomberg Economics base case. What's your sense, Ira, of whether this is basically locking in a very aggressive approach from the Fed, because there is not the same signs that people were looking for? They have come too late of any sort of deceleration.
Yeah, so I do think that that we have to consider that the Federal Reserve is going to go 75 basis points for sure in November, probably 75 in December as well, and maybe even 50 in January at the February meeting. So I think that we are pricing for a higher terminal rate at this point. I think the two big things and takeaways from the markets, and I want to comment on something that Mike McKee just said as well. First is the market is still pricing for interest rate cuts in 2023. I think first, at some point the market has to price those out. So I think that the market will ultimately do that, but first it has to find where it thinks the final terminal rate is going to be, and once that happens, I think that we can see that terminal rate flatten quite a bit. And I think Lyle Brainerd probably has it right, where once they reach that terminal rate, they're going to stay there for 9 to 12 months at least. So which is longer than they typically have. The other thing I do want to say is market function is a big deal right now. Certainly you've seen a lot of volatility. Bid offers are wider on a lot of fixed income instruments and things like mortgage-backed securities and the Treasury market. But one of the ironies is that the Treasury Department is still cutting the amount of issuance that it's treasuries that it's issuing, because one of the ironies is, as inflation's been very high, wages have gone up a lot, and tax receipts have come in way better than anyone ever expected. So we actually have the lowest deficits now than we've had in years, in terms of both monthly and annual basis. So one of the ironies of having higher inflation is that we won't have to issue quite as much debt in order to make up for government spending, which is a little bit ironic.
Well, given the rate outlook, certainly it would be very expensive and punitive for the U.S. to be borrowing at this point. I'm looking definitely on the front end. People are starting to price in the likelihood of at least a 4.5% terminal rate for some sustained period of time from the Federal Reserve. On the long end, I find this interesting. Also selling off, with 10-year yields hitting the highest since 2008, decidedly crossing that 4% threshold at a time when people are questioning whether we're going back to a low-rate regime. This is over the next decade. What's your view, and how has that changed, Ira, based on how people are responding to this news, that over the long term, this could indicate that it will be harder to get inflation under control, harder to get rates back to where they have been over the past few decades?
Well, keep in mind, we are still lower than the past few decades. If you go back to the early 2000s, we had, still in the historical context from the last half century, interest rates are still on the relatively low side. It's just not as low as they had been, obviously, the last 10 or 12 years. I think that the longer end of the yield curve, we will ultimately see interest rates below 3% at some point. I don't think we're going back necessarily to a zero handle on front end interest rates, at least any time in probably in the rest of my career. But we will probably see the long end rally at some point as we do price in for the Federal Reserve to cut interest rates. Keep in mind, like the higher the higher inflation goes, the higher likelihood we have of a very hard landing. And because the Federal Reserve will have to crimp down on demand by increasing interest rates, continuing its quantitative tightening programs, and that just means that we're going to have a harder landing later. And that means at some point, I think the long end of the yield curve will be pretty attractive. And I do think actually in the fourth quarter of this year, we will see the peak in yields, whether it's at 4.25% or right where we are today, is still obviously a matter of debate. I thought it would be closer to where we are right now, but obviously we have new data, so therefore we have to consider this new data in our forecast.
Ira, thank you so much for being with us. Ira Jersey there of Bloomberg Intelligence. Still with us down in Washington, D.C., Michael McKee, who's been parsing through all of the data and preparing for some pretty hard conversations, especially if Ira Jersey is correct in saying this is setting us up for an incredibly hard landing. How is this going to be communicated? At what point have people talked about actually putting a recession as a base case in the Fed forecasts?
I think a lot of people on Wall Street are putting a recession as a base case. The only question, as Ira brought up, is how hard it's going to be. The Fed has started talking about pain in the economy and that you can't get away with just raising rates and nothing happening, and I think you'll hear more of that. The Fed is going to emphasize the length of time they keep the Fed funds rate at its terminal point rather than where that terminal point is. The market's repricing right now, but it's hard to really put a figure on exactly where they need to go, how high they need to go. Their estimate has been that it would be about 4.5% to 4.75%. Some say 5%, but in that range. And does this really change that as much as people might think, since the Fed knew this would be a high inflation report and it's going to take time for inflation to come down? So Wall Street will debate this idea of raising the terminal rate, but for the Fed, it's going to be more a question of how long they keep the terminal rate up before they start cutting. And I know, Lisa, if you take a look at the WIRP function on the Bloomberg, something very interesting has happened. Ira says you got to start pricing out the idea of a rate cut. It's still there just slightly, but now the market is pricing in a rate cut at a rate increase, another rate increase at the end of 2023. So there's some confusion in the markets about what the Fed is going to do at this point, and of course Fed fund futures lightly traded, but it's an interesting change in the perspective of those who are trying to bet on where the Fed will be a year from now.
Mike, I was reading through the minutes yesterday of the previous FOMC meeting, and it was notable that there was a slight nod to the rest of the world, this question of some turmoil and how that will rebound back on the U.S. economy and cause issues domestically. How much is that gaining traction at a time where I'm seeing the euro once again fall versus the dollar, 96.68, dollar strength pervasive in the face of persistent inflation?
Well, it's obviously a major topic of conversation around here. The Australian treasurer says he's going to bring up to Jay Powell, watch what you're doing to the rest of us in the world. But most of the central bankers I've spoken with say they understand that the Fed has a domestic mandate, as do they, and they can't do a whole lot about it. They just have to let it go. And so the Fed is going to take this into consideration. One thing they have to take into consideration is how much this global tightens policy, tightens credit in the United States, so they may not have to do as much as they think if everybody goes up. But at this point, they know they're doing it. They know the rest of the world is tightening, but everybody has to do their own thing.
Michael McKee, thank you so much. As always, right now we're seeing the sell-off continue to accelerate into the open. Right now we're looking at the NASDAQ down near 3%, the S&P down about 2%. Dollar strength, yields higher, bond prices lower. The 2-year yield hitting 4.5%. On the 10-year, solidly north of 4%, the highest levels going back to 2008. CPI coming in hotter than expected, with core levels at the highest going back to 1982, on a day where people are looking to the Fed to understand exactly how this will be dealt with. Coming up, we'll hear from Kristalina Georgieva of the IMF. This is Bloomberg.
Absolutely brutal. Inflation up and equities down, and down hard. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. Inflation coming in hot. A 40-year high on core CPI, giving the Fed a green light to keep on hiking. With the market action, here's Katie Lyons. Hey, Kaylee.
John, absolutely brutal out there. We have seen a re-rating of the terminal rate expectations. Now swaps pricing in 4.85% when all is said and done this cycle. And that means yields are absolutely flying. Specifically at the short end on the 2-year, we're up 19 basis points on the day, 448. This is the highest we've seen going back to the summer of 2007. So basically, John, no, we had not peaked on the short end already. And at the longer end of the curve, the 10-year up 14 basis points north of 4% at 4.04. And of course, when you have yields moving higher, those higher borrowing costs weigh heavily on equities. We are seeing S&P futures dropping like a rock after the print, now down 2%. It's even worse for NASDAQ 100 futures, which are down now about 3 percentage points, given those are more richly valued stocks. So you want to sell stocks, you want to sell bonds after this. The only thing anyone really seems to be buying is the dollar. The Bloomberg Dollar Index is back up toward record highs, is essentially destroying everything in G10 right now, barring the British pound, which of course is related to UK policy and is a separate issue. But the dollar really gaining strength here. And John, just pour one out for the Japanese yen, right now trading at 147.35. These are levels we have not seen since crisis era, all the way back in 1998. And that is even above the levels we had already seen Japan policymakers intervening to stem the weakness in the currency. Post CPI today, that is just continuing because the BOJ is going nowhere, and this market is betting that the Fed is going to go even further than it already thought.
They don't need shots, they need a bottle. Yeah. Kelly Lyons, thank you. Kelly on the latest with the price action. Mike McKee down in Washington. Mike, put it all together. You've had 30 minutes to reflect. Your thoughts?
It's ugly, and there isn't much more you can say about that. Now, the Fed knows it's going to take a long time to start bringing inflation down, but I think they were hoping it wouldn't start going back up again. Now we've got 8.2% headline, 6.6% core on a year-over-year basis, and it's that core number that's scaring the markets, and it's going to make the Fed think twice about how quickly it needs to move. The biggest movers in the CPI this time, gasoline down 4.9%, still up by 18.2% for the year. Food at home up 0.7, 13% for the year, and those are two things that Americans are going to notice. And the problem with gasoline is it's going to go back up again. Owner's equivalent rent up 0.8. That's an increase from the last 4 to 6 months, and it's up 6.7%. So housing, a major component of the CPI, about 1/3 of it, and it is putting a lot of upward pressure on the core. Used cars did drop 1.1%. We've been waiting for that. Still up 7.2% on the year, and apparel down 0.3. Interesting, you look at the apparel category, and just about everything went down in price. There are a lot of sales. Inventories are high at retailers, so we should expect to see continued drops there. There were some surprises, though. I mentioned gasoline goes down, but natural gas goes up by 2.9%, and it's not even winter yet. This may be because there's a bit of a shortage of gas as we sell a lot overseas, so it could become a political issue. And of course, as it gets colder, it'll become an issue for voters. Airline fares supposed to drop as the summer travel season over, up by 0.8, and medical care 1% higher. There is some thought that that may drop off. Methodological changes are coming into force next month, so if that drops, that would be a big help. But the real question is, how high does the Fed go? They've never had a tightening cycle where they didn't go over the level of inflation. Right now, they're raising rates, but inflation's still going up. So they aren't able to close that gap, John.
What a tough spot. Mike McKee down in D.C. Mike, thank you. This inflation print hijacking the conversation, the debate down in Washington. Mike talked about this becoming political. It is right now. It's the last CPI report before the midterms. Later this hour, the view from the White House with Brian Deese, the National Economic Council Director, coming up a little bit later. Let's get to the guests. Morgan Stanley's Jim Karen, Mona Mahajan of Edward Jones. Mona, first to you. Your thoughts on this one?
Yeah, John, look, this is presenting a real challenge for not only the Fed, but the broader economy here. You know, inflation was supposed to be moderating. We were looking for 2 to 3, maybe 4 prints lower. In fact, today we got a print that is moving in the wrong direction. Of course, what we're seeing is this repricing in markets. The Fed, market expectations for the Fed, now 100 basis points on the table for November, December looking for another 75, and perhaps after that we start to see a bit of moderation in Fed rate hikes. Now, keep in mind what we're watching for, of course, with such dramatic moves in yields. Will we face any sort of liquidity issues? Some of the credit disruptions we saw in UK, could they come here to the U.S. shore? That's something to keep an eye out on in the weeks ahead, of course. But I think generally, although this print was very disappointing, one thing we are watching are the underlying fundamentals. Yes, shelter and rent in the CPI are moving higher, but when you look at underlying fundamentals in mortgage rates, in housing, in broader rental markets, we're actually seeing the opposite trend. There is a lag impact, and so over time, we do expect those components to moderate as well. It seems like it's taking a bit longer than expected.
Hey, Jim, this is brutal.
It is brutal. I think that's a good way to sum it up. I mean, look, you know, we're in a situation here where we thought the Fed had made a one-off adjustment to get to the policy rates up to 4.75%, and the markets mainly thought game would be over at that point, and now it looks like we're going into extra innings. The question now that we all have to ask ourselves is a 4.75% policy rate, is that enough? Or should it go into the 5-handle area? And John, you and I have discussed this before, but I have called this the RIP cycle, which is recession, inflation, and policy risk. The more the Fed has difficulty fighting inflation, the more they have to hike rates, the faster they go, the more likely they are to create a recession in 2023. So I agree with Mona. I do think that prices will start to moderate. I thought that this would already be happening at this point. The issue that we have here is that now we're seeing inflation move from the goods sector and permeate into the services sector. The problem with that is that when inflation starts to broaden, and that's the real problem, it's starting to broaden, it makes it very, very difficult for the Fed to hike because it gets embedded in inflation expectations. Clearly, we're seeing demand right now in the economy. Wages are high, you know, wage inflation is there, and people are able to afford these higher prices, but for how long? And that's going to be the question for 2023. So the faster rates go up now, the more likely there is to be something breaking in the economy in 2023, which is why the yield curve remains somewhat inverted.
Jim, you've got to the heart of it, and it's about where this Fed funds peaks. The move we're seeing at the front end of this curve right now, with twos up 21 basis points to 450, how we're pricing a terminal rate through next year. Jim, I think the question we've all got to ask is the one you're trying to get at. Just how much upside risk is there now to the terminal rate based on where we're priced this morning?
Well, if the way the Fed calculates this and they measure this cost of fighting inflation in terms of the unemployment rate, so I'm going to work backwards on this. I'm going to say that it takes an unemployment rate north of 4.5%. Today we're at 3.5% unemployment in order for us to start to really tame inflation and wage inflation. And as I continue to work backwards on this, then I have to say what policy rate is required to get the unemployment rate up into the 4.5% to 5% area. And I would argue that it's a policy rate that is somewhere between 5 and 5.5% beyond what the 4.75% is today. Now, I'm not making a forecast on this. I'm just doing a calculation on this, and I'm suggesting that unless something changes, it's going to take more rate hikes from the Fed to bring up the unemployment rate in order to tame wage inflation, which I believe they think is the source of a lot of this inflation.
Jim, stay close alongside Mona. Big moves in this market. Your equity market down by 2 percentage points on the S&P. At the front end of the curve, up 22 basis points on a 2-year to about 451. TK down in Washington. Tom, some big moves here on Wall Street.
John Farrow, thank you so much. And really interesting conversation there with Mona and Jim about these market moves. What it means for me is I'm trying to suggest a 1-hour conversation with the managing director of the International Monetary Fund. Her entourage says that's not going to happen, so let's cut it down to 20 minutes. Managing director, thank you so much for seeing us. I have a plan. Eric Martin briefed me over a beverage of my choice last night and gave me this beautiful plan of discussion. We're going to rip up the script, and we have to because of inflation. When you speak to your PhDs, when you speak to Gita Gopinath and the rest, and with your doctorate as well, do you have a character or understanding of this inflation? What is the makeup of this inflation that won't seem to go away?
The makeup is one, disruptions from Omicron, and they continue in China. Two, Russia's senseless war against Ukraine that has pushed energy and food prices up. We also are going to see some repositioning of supply chains that would have longer-term impact on cost structures. But right now, what we face is demand remains quite strong and supply has trouble meeting it. The most important task we have to secure our economies is to win the fight against inflation. And that means for central banks to show the resolve that is necessary. And why we need to do that? Why do we need to win this war? Because if we do not have price stability, we undermine prospects for growth, and because we hit incomes of people severely.
Things are moving quickly. The U.S. real yield, as Jim Caron of Morgan Stanley just mentioned, moves 10 basis points. The 2-year yield moves, I believe, 18 basis points. Do you suggest, would the IMF suggest to central bankers, including Chairman Powell, that they need to slow down the dialogue and the certitude, the rhetoric, and extend the timeline out, even at sacrificing a higher inflation, to provide for financial stability?
What we are suggesting is that the Fed needs to continue to be data-driven. They need to look at the economy. They need to look at where the signals are in terms of are we reaching price stability or not. And then they need to look at the impact their decisions would have domestically, but also internationally. Let's remember, tighter financial conditions also mean stronger dollar, also mean capital outflows from emerging market and developing economies. Of course, the Fed is primarily focused on domestic conditions. The responsibility of the Fed is price stability in the United States. But also the Fed has been quite active to think of ways to support global stability, especially through extending swap lines to a large number of countries.
Give us an update on that right now. We talked to the people of the Green Book, the Financial Stability Book. What is the IMF's present tone on the quality of the liquidities in the market, given this inflation report this morning?
We have seen financial stability risks increasing, but we are still primarily concerned about inflation running out of control. If it maintains so stubborn as it has been so far, then the most significant risk we face is that inflation expectations de-anchor. And when they de-anchor, that means then pressure on wages to go up would fuel inflation from other directions. And then the job of the Fed would become harder, and it needs to tighten even more.
Two more questions very, very quickly here. You met yesterday with certain members of the British government, I believe a gentleman from the Bank of England and a beleaguered Chancellor of the Exchequer. Did you put them out in the proverbial American woodshed? I mean, give us the insight. No one's listening or watching right now. How did that bilat go with the two members of the United Kingdom?
It went really well. It was a very constructive meeting. We talked about the narrow path that the world economy has to walk on today, and how important it is not to make missteps out of this path, and not to communicate in a way that may be more difficult. What I was very encouraged to see is that the two of them sitting together with a common purpose. The Chancellor talking about his intention to accelerate a projection of how he's going to anchor his budget in medium-term fiscal sustainability, and also his commitment for the Office for Budget Responsibility to come up with independent projections. That all tells us what we know, that the UK actually has strong institutions, and they do work even if at some point we may see some
With those comments, you'll be invited to the coronation. Dr. Gorgieva, thank you so much. Greatly appreciated. On this day of a surprise inflation in America, John Farrow, Kristalina Gorgieva.
It's EK ugly on this side of things, that's for sure. Tom, thank you. Great work as always. In sum, ugly all around. The words of Mohammed Al-Arian just moments ago. Coming up on this program, The View from the White House. That's next.
If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target range for the federal funds rate should remain on the table.
That conversation coming up.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question. Great question.
Great question. That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target range for the federal funds rate should remain on the table. However, if inflation starts to decline, I believe a slower pace of rate increases would be appropriate.
The Fed getting that green light to keep on hiking, inflation ramping up the pressure on the Biden administration with just weeks to go until the midterms. For more, let's get to Josh Wingrove down in D.C. Josh, have they got to own this one?
I think they're going to try to squint hard and find whatever they can talk about, maybe that top line non-core number trending down and saying the Fed still has work to do, but this is bad news, of course, for Joe Biden and for Democrats. It's the last data that we're going to get before those midterm elections, where Democratic hopes have been kind of rising a little bit, that they would avoid a bloodbath that had been coming down the pipe 6 months or so ago, and still have a really close race for the Senate. The House is still looking favorable for Republicans. So this will give Republicans ammunition going into those final weeks of that campaign to say, look, prices are out of control, and you need to switch who's in power in Washington to do something about it. On the flip side, they will continue to point to that Inflation Reduction Act. They, will talk about the reducing or the lowering levels in drug pricing from that. Of course, that still takes time to kick in. And I suspect the Social Security bump that was announced this morning is also going to be emphasized by President Biden to remind voters, particularly the elderly voters, that they might get more money coming into them to deal with this. So that's the sort of top line, but it is as we've said, as all the guests have said, this is just a brutal print all around it that makes it brutal for Joe Biden.
What are the options on the table for them now? They're in this scrap with Saudi Arabia, the kingdom over the last week or so on this OPEC Plus decision. What's left on the table for them?
Not a lot. We don't know what consequences President Biden has been referring to after that OPEC decision. We were, looking for more on that. Of course, we continue to watch what, if anything, they will do with the SPR, where the ongoing release that they promised in the spring is sort of coming to an end. The question is, do they expand that or keep it going in any way to try to stabilize oil markets in particular? Other than that, there's no hope of any sort of, bill or anything that kind of thing going through Congress before these midterms or after. So I think right now they just have to try to stay the course, or they're going to say that they have to stay the course and see where it goes. But as I say, they'll have to try to find a silver lining on this one, and they're going to have to look pretty hard.
Hey, Josh, thank you, buddy. As always, Josh Wingrove down in D.C. Tough to find a silver lining. That job is going to belong to Brian Deese of this administration, the National Economic Council Director. Brian's going to join us in about 20 minutes' time. Back with us for some final thoughts, Jim Kerr and Mona Mahajan. Mona, thanks for being patient with us. You heard that Gorgieva interview, the IMF Managing Director. Should we have renewed concerns, increased concerns about financial stability, and how difficult will it be for this central bank to bring down inflation, address that with higher interest rates, and at the same time not cause a big problem in this market?
Yeah, I think it's now a higher tail risk than we had originally expected going into this print. And keep in mind, in the U.S., we haven't yet seen some of the instability we are seeing across the globe. Credit spreads here in the U.S. are relatively contained still. Yes, the inverted yield curve has been persistent, but it hasn't been exacerbated in magnitude over the past few weeks. We have seen relative stability across market and market functioning. So we'll be keeping an eye on that one. Keep in mind, as we continue these Fed rate hikes higher, perhaps through February, maybe even beyond, the question then becomes, there is a lag impact from those Fed rate hikes. We've now probably raised rates close to 400 basis points for the year. In 6 to 12 months' time, that will hit the real economy in a more meaningful way. Does this potential recession then become perhaps not deep, but maybe prolonged? And I think that's where the equity market adjustment may have to still yet be reflected. We are, of course, today seeing a larger impact, outsized impact, once again on the higher valuation, growth parts of the market, relatively less impact on the value and defensive parts of the market. I think that theme still has some legs in the months ahead as well. So both things to keep an eye out on. I think for now, the U.S. credit markets are functioning, but with these rapid rate increases, I think that's a tail risk we have to monitor.
And that's the key word, functioning. Jim, for the bulls, we have a price problem. I get it, but the Fed's not going to care about that. Do we have a market functioning problem in fixed income?
So right now, I would say it's functioning. Liquidity conditions are certainly stressed, and you're seeing that with some risk premia of assets moving higher. And it also explains some of the gappy moves that we've been getting. But ultimately, when we think this through and we try to bring this forward, it all goes back down to what I think of as, if this was a football match, it would be labor versus capital. Labor is at 5, capital is at 0, and essentially capital could be considered asset prices as well. And what we have to try to consider here is, if the Fed is very serious about fighting inflation and getting wage inflation down, then there's a very difficult message that needs to go out to the U.S. public, which is that the labor market has to soften in order to get this inflation under control. Now, the more the Fed starts to hike rates, and to get to your point, John, in terms of the functioning of the markets, essentially, if the Fed is going to go 75 basis points in November, if they're going to go maybe 75 basis points in December, 50 to 75 in December, and they're going to get up to that 4.75% rate very quickly and maybe go higher, it is a question about a little bit of a pig through the python. These are a lot of rate hikes that are going through the markets over the past few months and going forward. It's going to take a toll at some point. It's always hard to figure out what's going to break or when that might actually happen, or even if that might actually happen. But the more the Fed does this at an accelerated pace, not only does it risk a recession in the future, but it does risk some type of liquidity breakdown at some point. And that's something that is just going to be an added risk premium that gets put into the markets that's going to weigh on asset prices.
Hey, Jim, it's good to catch up. Thanks for being with us this morning. Jim Kerr and Mona Mahajan coming up. The morning calls and later a monster upside surprise on inflation. We'll catch up with JP Morgan's Tom Kennedy around the opening bell. The opening bell, 7 minutes away.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Inflation coming in hot, yields up, stocks down. We're down by 2% on S&P 500 futures, down by 2.9 on the Nasdaq. Here's some morning calls for you. First of all, this one from B of A upgrading Las Vegas Sands to neutral, pointing to an improving macro environment with Macau headwinds starting to fade. JP upgrading Colgate to overweight, expecting the company to maintain pricing power. And finally, Citi downgrading Amex to sell, warning investors about the potential fallout from a looming US recession. That stock is down by more than 4%. Coming up, ugly inflation report, teeing up earnings season. JP Morgan's Tom Kennedy joining us at the opening bell. That opening bell is up next.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
6-day losing streak is about to become 7. Equity futures deeply negative, 20 seconds away from the opening bell. Good morning to you. We're down 2% on the S&P 500. On the Nasdaq 100, down by 2.9%. On the Russell, the small caps down by more than 2%. Inflation coming in hot and sending this equity market down, down, down. In the bond market, yields up, up and away. Twos right the way through the curve. On a 10-year, up 16 basis points, back through 4%. On a 2-year, your 2-year yield this morning in America is up, and it's back through 450. When was the last time you could say that? 451 on the 2-year, up 22 basis points on the day. In the FX market, euro dollar, stronger dollar. Euro dollar 96 handle, 96.66. Dollar yen all over the place, 147 on my screen right now. And crude lower by 0.9% to about $86.50. In the equity market, around the open, about 30 seconds into this, we're down by more than 2%. On the S&P, on the Nasdaq, we're down by 2.9 percentage points. Markets feeling the pressure from inflation. Investors now shifting their focus to one thing.
Earnings season.
Corporate earnings.
That is the next thing that the market has to focus on.
We're seeing some pretty bad earnings already.
We're going to look for guidance from CEOs and CFOs.
Investors are looking for outlook.
Recession talk.
A lot of companies have failed to provide outlook and any guidance and certainty.
We don't know yet how much they're going to come down.
How are they going to maintain margins?
It's the margins.
Profit margins. Margin pressure.
That's going to be the sticker shock, I think, coming out of these earnings.
The trouble still lies before us.
Is that the next shoe to drop? Joining us now is JP Morgan's Tom Kennedy. Tom, fantastic to catch up with you, buddy. It's been way too long. Let's start with the inflation report. It's 60 minutes old.
Connection lost.
Yeah, good morning. This solidifies 75 basis points at the November meeting. The Fed is going to have to look at this inflation report and suggest that more tightening is necessary, even if that's a lagged effect on the economy. John, I try with my clients to give them long-term perspective about what could happen. I think you have to call it as it is. This is a hot labor print, a hot inflation print. The driver here is shelter. When and how is that going to roll over? At this point, when I get to talk to clients in our platform that are big real estate owners, they're starting to get substantial pushback in the commercial side of things and now in the residential side.
Their assessment of the Fed, Tom, in the last decision, in the minutes we saw yesterday, this quote: the cost of taking too little action to bring down inflation likely outweighs the cost of taking too much action. Do you agree with that assessment?
I think that assessment is becoming more balanced. The Fed has tightened conditions in a historic fashion, John. We have never seen, absent a recession, financial conditions tighten the way they have in the last 9 months. It just takes time for that to filter through. Another thing in the minutes last night that wasn't really talked about as much is the Fed keeps ratcheting up the conversation about wage spirals. And when you start to look back to the Volcker era, those are the things that prompted monetary policy to be so tight then. This inflation report today, we can start to find seeds of, is that probability of a wage spiral? I think it's very low, but non-zero. I think it's going down. How did I get there? Core service inflation is not accelerating anymore if you remove shelter. And some of the more wage-sensitive sectors are not showing evidence of acceleration. The levels, John, are way too high. We know this. But if you're trying to find a silver lining, which is hard to do in this report, that's the one I would focus on.
I think a lot of people were hoping that we'd see more of that, and that we'd go into this November Fed meeting and we'd lay the groundwork to have a downshift in rate hikes from 75 to 50, perhaps to 25. Tom, how do you think this changes that news conference with Chairman Powell in early November now?
Yeah, the downshift, if there was a probability it would happen in November, is off the table. And the next conversation, I think, for the Fed will be, are we going 75 again in December? The downshift, John, to your point, just keeps getting pushed out. general consensus it will happen at one point, right? And that's an easy thing to say. The further you get away from, or the higher you get from an estimated neutral rate.
You brought up a really good point, and it's how much work we've already done. The temptation on a morning like this morning, Tom, and you know it well, you see a number like that, you sort of run away with yourself, and you're like, they should go 100, 125, 150. Let's just wait and pause and think about what we've done already. 6 months, 300 basis points of tightening. Mortgage costs have more than doubled. I think the mortgage rate's got a 7 handle now in America, Tom. We've seen what's happened to financial conditions. We've seen what's happened to the US dollar. Can you tell me about the way you think about long variable lags in policy? All of that tightening in the pipeline already. When does that start to hit?
Yeah. The U.S. economy, John, has different lags, to your point. Investors and the Fed will focus on very short interest rate cycles, like the real estate market. As you mentioned, that market is getting hammered. Unaffordability is 07 all over again, and mortgage applications is the lowest we've ever seen. So desired effects are happening there. The reason folks will now focus on margins is that's a longer interest rate cycle. And that should be the next shoe that drops. Unfortunately, once you start to really pressure margins, that's when layoff activity starts to follow. I think this progress is just taking a little bit longer than we thought. The resiliency of the economy is there. Now, the question, John, to you said this really nicely. When was the last time we saw a 2-year treasury rate at 450?
Yeah.
For a long-term investor, these type of yields are wildly attractive because we're already seeing the desired effects of slowing growth. You can't slow growth forever. Eventually, that will mean something for inflation.
Well, Tom, let's talk about opportunity then. You look through the curve, 2s out to 30s. We can have a chat about duration. Then we can look out to credit risk, think about maybe IG, perhaps even dabbling in high yield. I mean, you can tell me. Where do you see the opportunities right now?
The screaming opportunity to me is in core, boring, traditionally unsexy fixed income, things like investment grade and municipal bonds. John, over the last 20, 25 years, the S&P 500 has annualized you about 6.5%, 7%. We can find those current yields in fixed income, less risk. So I think that's the screaming opportunity here. We are of the mindset that a recession in America is more likely than not next year. And I don't see that fully priced in the equity market. I don't see it fully priced in extended credit. So finding dislocation opportunities is our next best idea. And then monetizing volatility through structured notes. You can get downside protection and still get double-digit coupons. These are relatively defensive ways to aggregate wealth.
Tom, at the moment, I think that a lot of people like you are experiencing 2 different conversations with clients. One right now is the fog of war with inflation, what the Fed's going to do, where Fed funds peaks, and whether inflation comes down, and what should I do, like right now, with a time horizon of 5 minutes and maybe out to 6 months. Tom, the other conversation I'm hearing more of is whether this period is just an aberration and we go back to the playbook of pre-pandemic, low rates, low inflation, low growth by tech. You're going to see duration kick in again, yields go back down to, say, at 1 handle, maybe 2. Tom, have you given thought about the long-term story, the destination here? Is this just an aberration, or is this a real regime change, a breakaway, a permanent break from the last 10 years?
No, I don't think it's a permanent break, Jonathan. There are, of course, going to be things that are different, and I think we have to, the most obvious one is we have to question how much confidence we can have in 2% inflation. But the longer run drivers of why interest rates have come down don't appear to have changed to me. And they're the ones we talk about all the time: aging demographics, technological advancement, the globalized connection. That deglobalization theme is getting a lot of attention. But any onshoring that happens to America is most likely to come in automation. And is that in the tech column, or is that in the deglobalization in the higher inflation conversation? So I do think rates, all else equal, are wildly high here, and over 3, 6, 12-month horizons need to come down. So I think that's the opportunity set for a long-term investor.
A final question then, and it's a short-term one, I guess. It's about 12 months away. I asked this question of Jim Kerr, Tom. I'd love your assessment of it. The upside risk to the terminal rate at the Fed, just how much upside risk is there now, given how much we've already priced in?
I mean, 5% after this morning is probably where the market will settle today of what terminal Fed funds will be. Upside, downside to that is, I think, will be warranted a true assessment after Q3 earnings. If earnings margins don't contract, Jonathan, we could easily reset that to 550. But if earnings and margins reset in a substantial way, we might have downside risk to that 5% number. So I guess a different way to answer your question is I think we're symmetric on those risks of terminal relative to 475, 5%, which is what's in the price.
So, Tom, if we've priced that and maybe we've more fully priced the Fed hiking cycle, how much have we priced the damage that will do to earnings?
Yeah, I think that's the piece that's missing, Jonathan. We're all focusing on what equity strategists are saying for earnings going forward, but that's just a number on a piece of paper. I think all of us have reset our earnings estimates somewhere to around, on the S&P 500, 200, 210. And now how much pain does the Fed have to inflict is whether that number should really be for 2023 earnings 180 or is 210 really likely? When we run our scenarios, Jonathan, downside risk to equities from here, it should be more limited. At 3,200, 3,300, you're pricing in a meaningful recession, a full-fledged recession. So that's going to be the awkward part, I think, for investors, at least in my community, of if we're not even seeing the recession, but the market has fully priced it, how do I match my investing know-how with my behavioral experience?
Hey, Tom, what a tough moment. Thomas Kennedy at JP Morgan. Tom, happy to share this morning with you. 60 minutes after another historic print for U.S. inflation. A lot of stocks on the move. Equities down by 2%. BlackRock is down by about 3.8%. Down in Washington, I'm pleased to say, is Bloomberg's Sonali Basak. Sonali, you and I are going to talk about this one, and then we're going to have a busy morning tomorrow morning talking about Wall Street.
We sure are, John. We're going to talk about BlackRock first because those assets have gone below $8 trillion. That is less than what Wall Street was expecting. Earnings per share came in higher than expected here, but again, there are a lot of jitters in the market about what a falling market would mean for a firm like BlackRock. Now, fixed income flows were still healthy, but you did have equities under pressure, the retail business under pressure, and certain parts of the institutional business under pressure, but not as much as the retail business. Now, to your point, if you fast forward to tomorrow, the big asset management arms of the banks are not what we normally zero right in on, but it is another source of pressure that they'll have to contend with, mostly due to falling markets, lower fees, and their clients under pressure.
Sonali, looking forward to the conversation on Wall Street this morning. Pretty much every bank under the sun before the opening bow. Sonali Basak down in Washington will be all over that in the next 12 hours. Coming up on this program, a hot inflation surprise, ramping up the pressure on the White House.
I don't think there will be a recession. If it is, it'll be a very slight recession. That is, we'll move down slightly.
The National Economic Council Director, Brian Deese, joining us next. Around 133,000 people, Tom, watching Big Jet TV, which is just planes coming into Heathrow, landing.
We should say it made
the
a high
country.
wind, and it's absolutely spectacular to see.
Come on, mate. That was mad skills. Nice one.
Is that your impression of someone in the UK?
No, that wasn't.
Yes, it was, wasn't it? That was it. A Bloomberg subscriber just wrote in and said Lisa's accent, her English accent, is more authentic than mine.
Mad skills.
Beautiful thing, mad skills.
Bloomberg surveillance, big planes, strong impressions, mad skills.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns. And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Live from New York City for our audience worldwide on TV and radio, White House National Economic Council Director Brian Deese joins us right now. Brian, fantastic to catch up with you, sir. Core CPI in America, 40-year high. This is the last inflation report before the midterms. Does the White House take any responsibility for this whatsoever?
Well, look, it's clear that inflation is a challenge. It is a global challenge affecting countries around the world. And I think the first and most important point to make is that the United States is in a better position than virtually any other country to address this challenge and do what is necessary to bring prices down without having to give up all of the economic gains that we have made. That continues to be our focus, and that will continue to be our focus until we get this job done.
The challenge is getting bigger. The president acknowledged this week the potential for a very slight recession. His words, his assessment. You briefed the president this week, Brian. Have your internal forecasts become more or less negative over the last few months?
Well, I think it's important to look at this monthly data in context. We are seeing some progress. If you look at annualized headline inflation over the last 3 months, it was about 2%. That's down from 11% in the prior quarter. Now, a lot of that is the significant reduction in energy prices and in gas prices at the pump. Obviously, economists tend to strip those out and look at core, but for typical American families, for workers, the reduction in gas prices by more than $1 a gallon in most places in the country is a meaningful and real sign of progress. At the same time, we're seeing some elements of a transition which we anticipated, but now focus on the work ahead. Shelter inflation represented more than half of core inflation for the last couple of months. And obviously, that's a place where we're going to have to look very carefully because there is a well-known understanding that data operates with a lag, and we're seeing some contemporaneous real-time evidence of sharp deceleration in rental price appreciation, sharp deceleration in home price appreciation. So that's going to be an area that we're going to have to stay very focused on here in the days and months
Brian,
ahead.
can you see why people get really frustrated with politicians? 12 months ago, 6 months ago, you would have said strip out gasoline and look at what's happening elsewhere. And now it's leave gasoline in because gasoline is coming down. Brian, can you see why people are very frustrated with the way the White House has navigated this issue?
No, look, I'd take issue with that characterization.
Why?
We always say that we look at the data, because we always say that we look at the data in the aggregate, and there's a reason to look in the fullness of overall inflation, and then also to look at elements of the core, like I just said. For typical American families, gas and food are big parts of their typical budget, and food prices in this report and in prior reports are moving up too fast, and that's something that we need to make more. We need to make more progress on. So we look at all of the data and understand the point about gas prices is just a very salient one. Your outlet, various others over the course of the spring spent a lot of time focused on the increase in gas prices and the impact that has on the economy, on consumer sentiment. Now that they're coming down, it's important to recognize that has an impact on the economy as well.
Well, more recently, they've been going back up, as well you know. It's why you've been very critical of Saudi Arabia over the last week. The president talked about consequences for Saudi Arabia. Brian, what consequences? What are they?
Well, I'm not going to get ahead of the president, and as he said, he will make those decisions and make those announcements when he is prepared to do so. I think our focus right now is on continuing to make that progress. If you look nationally right now, gas prices are still down about $1.10, $1.20 from their highs this summer. We're seeing some welcome moderation in certain areas of the country, the Midwest and California now. And we still face this historically large gap between the wholesale price that energy companies pay for refined products, gas, diesel, otherwise, and the retail price that consumers are paying. So that's a continued area of focus. Obviously, refinery and refinery capacity is an element of that, but that's one of many areas that we are working with the industry and trying to focus on what we can do from a practical perspective, from a policy perspective, to try to move the ball forward.
On OPEC Plus, the NSC spokesperson John Kirby called the decision short-sighted, a short-sighted decision that benefited Russia. Can you understand why using the SPR as the strategic midterm reserve is a short-sighted decision that only leaves this country even more exposed to the whims of OPEC Plus next year?
No, look, I disagree. We said that the OPEC decision was short-sighted precisely because the lack of supply and reliable supply continues to be the dominant challenge globally in energy markets. The lack of supply continues to be the dominant risk. And the use of the Strategic Petroleum Reserve in a historic but calibrated way starting last winter was designed to address that problem and to help have additional supply on the market during this transition and during a period where we knew Russian supply was coming off and U.S. producers were ramping up. That's why if you talk to most energy market analysts, they will point to the fact that that use of the Strategic Petroleum Reserve as a bridge as U.S. producers brought production back online, was one of the principal reasons that kept oil prices from moving up even more quickly over the course of the summer and into the fall. That's a prudent use of the asset as a transition as U.S. producers ramp up.
You say it's a prudent use of the asset. Other people are very worried about this. You've drained the SPR to its lowest level in 4 decades. There's some accusation that you're putting the polls before America's energy security. Brian, the Saudis themselves said this morning that the U.S. requested a 1-month delay to the OPEC Plus output. I wonder why that would be. Brian, can you tell me whether you did ask the Saudis for a 1-month delay to that decision? Are they telling the truth?
Look, we clearly communicated our views to OPEC members that we thought it was short-sighted for them to take the action that they were contemplating, and they announced. With respect to the Strategic Petroleum Reserve, this was a calibrated decision to address the real issues in the market. We talked to U.S. industry last winter. We identified that there was about a 1 million barrel a day gap between what they were producing this winter and what they said that they could get production to by late this fall. That 1 million barrel gap was what we calibrated to make the decision on the use of the Strategic Petroleum Reserve. And people should feel confident that the Strategic Petroleum Reserve continues to be an asset that we can deploy to address our economic and national security needs. That's always what has dictated the president's decision-making on this, and that's what will dictate his decision-making on this going forward.
Brian, you didn't answer the question, so I'm going to ask it again. I'm going to share with you and share with our audience the quote from the Saudis this morning. The government of the Kingdom of Saudi Arabia would like to clarify that based on its belief in the importance of dialogue and exchange of views with its allies and partners outside of OPEC Plus regarding the situation in the oil markets, the government of the Kingdom clarified through its continuous consultation with the U.S. administration that all economic analyses indicate that postponing the OPEC Plus decision for a month, according to what has been suggested, would have had negative economic consequences. Brian, again, it's a really straight question. Did you ask the Saudis to delay that decision for a month? Are they telling the truth or not?
Look, I'm not going to get on air and disclose private conversations that members of our administration
the Saudis have shared it with us. You've got the opportunity to say it's true or not. Is it true or not?
What I will say clearly is that the communications that we've had with OPEC members and continuing have been based on our assessment of the economic circumstances of supply and demand in global oil markets. We disagree with the assessment in that statement that it was economically the right or necessary or appropriate thing to do to reduce production at a time where the lack of global supply on the market continues to be the predominant challenge in global energy markets. That has been and continues to be the motivation behind all of our engagements internationally.
Again, they're suggesting it's a political one, that your strategy is political, that your effort to get energy prices is a 1-month story.
I understand what they're suggesting, and what I'm saying to you is that our strategy, I understand what they are suggesting, and what I'm saying to you is that our strategy has always been grounded in an assessment of the economics of the situation and what is prudent for the global economy, for U.S. economy and U.S. families.
So the way you would have some kind of viable energy policy from here is to make the decision as to whether what we're experiencing right now is a one-off shock or something more permanent, a one-off winter or something more permanent, a permanent shift away from Russian energy. Brian, which one is it?
we're in a transition where we face some very immediate challenges, but absolutely energy markets globally and in the United States are going to go through a transition. We're never going to go back to the pre-pandemic or the pre-Putin invasion paradigm on energy policy. And that's frankly why, even as we have worked to address very immediate term issues, including helping the Europeans increase their reserves of natural gas going into this winter to try to address those immediate challenges, we have been focused on long-term prudent energy policy and providing incentives for U.S. producers of cleaner sources of energy to produce at scale and at speed that they've never done so before, and to do so in lower cost ways here in the United States so that we can be a reliable supplier of clean, low cost electricity to our industry, to our own consumers and families, and to the world. The United States, the Biden administration have focused on that. We prioritize that. And in fact, we have now legislated long-term incentives to drive exactly that kind of investment in the United States. And that's based on an understanding that we are going to continue to be in a historic energy transition, not just in the months ahead, but in the years ahead as well.
Brian, if this is not a one-off shock, if this is a permanent shift, can we complete the conversation by you telling me how it's a viable strategy, a sustainable approach to drain the SPR to a 4-decade low? If it's not about politics, why is that viable? Why is that strategy sustainable?
Appreciate the question. It's a mischaracterization of how we use the Strategic Petroleum Reserve. We announced a policy that was explicitly designed as a temporary bridge over the course of months, 180 million barrels, to bridge a temporary situation while U.S. producers were ramping up supply in the short term. Our long-term challenges around energy are about investing in increasing the supply of clean energy in the United States and globally at massive scale. Those require different policy tools, which is why we've enacted historic incentives, $370 billion in long-term incentives to increase investment in the United States. That's the right long-term policy solution. We can take short-term and temporary measures that are prudent and well-calibrated alongside long-term measures. That's what we've been doing.
Brian Deese, we appreciate your time this morning, sir. We really do. Thank you very much for choosing Bloomberg TV and Bloomberg Radio to have this conversation. Brian Deese there, the National Economic Council Director, following U.S. inflation, core inflation coming in at a 40-year high. Here's the trading diary for you. The next couple of days ahead going into the weekend. President Biden discussing infrastructure from LA at 2:15 Eastern time. Then on Friday, the big banks reporting earnings with results from JP Morgan, Morgan Stanley, Citi, Wells Fargo, all coming ahead of the opening bell. We get U.S. retail sales, UMich consumer sentiment survey, and finally, more from the Fed with George, Cook, and Waller all on the agenda. Inflation coming in hot in America. Equities down and down hard, off by 1.3% on the S&P. The Nasdaq down by 2 percentage points. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 138, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right? right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache, I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed Harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. Education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as describe about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW, and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero. I aim to be a top-notch engineer. I am a Swero. I aim to be a top bureaucrat of this country. I'm a Swero. I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College. And then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the